Hello, in this video, I'm going to discuss with you the three types of home loans, as well as the do's and don'ts to do while you are under contract to purchase a home. Home loan number one, VA loan. This is for veterans, active duty veterans, retired military, folks who, like me, had their honorable discharge. The pros of this loan is that there's no down payment needed. You don't need private mortgage insurance. What's that? Glad you asked. It is a monthly fee, $100 to $200, that is added on top of your mortgage. VA loans, don't have to worry about it. You also have a lower interest rate with the VA loans. The reason why is because the government backs and guarantees a big portion of that loan, so the banks are willing to charge less interest to borrow the money because they know Uncle Sam is going to pay them back if you default. The cons of a VA loan is stricter inspections and appraisal standards. So this can sometimes be an issue. You do your inspection, inspector's like, hey, the house looks good. The VA appraiser will come out and they may say, hey, we want you to fix this and that. And we also don't think the house is worth as much money as you guys think it is. These protections are in place to protect the veteran themselves. And you also want to have a credit score of at least 600 or above. The second loan is a FHA loan. This is for folks who don't have a 20% down payment available. Military who have already used a VA loan can also use a FHA loan. What I see a lot happens, and I've done it myself, I use my VA loan, don't have to pay no money, buy a house. Then I use an FHA loan with only 3.5% down to purchase a home. The pros of the VA loan, FHA loan is it's a low down payment, only 3.5% of the sales price. Con is there's a permanent PMI payment associated with the loan, and you typically want to have a credit score of about 600 or above. Conventional for anybody. The pro of it is a faster underwriting period, as well as flexible years of repayment. You can get 3 years, 5 years, 10 years, 15 years, 30 years. The PMI, the private mortgage insurance payment, also drops off once 20% of the loan has been paid. A con of this loan is it's a higher down payment, typically 5 to 20%. You're going to want a credit score of 620 or more. Now, while you're under contract to purchase a home, do not, please, make any new purchases on your credit card. Don't apply for any new credit cards, and don't open up any lines of credit such as furniture, new cars, etc. What happens is any new amount of debt added to your credit profile will affect it, and the mortgage lender days before your closing is going to look at your credit again, and if your debt to income ratios are out of whack, you're probably not closing on the home. Do spend as little as possible to have as much extra cash on hand as possible. Do pay credit cards off exactly to the amount your mortgage lender would suggest. Anything above or below can oddly interfere with your pre-approval. So if they say pay $43.12, just do that. Do continue making all your bills on time. A late payment can wreck your profile. I've had clients where they're purchasing another home, they were selling their home, they decided not to make the mortgage payment on their home because, hey, I'm closing on it soon. Well, the closing got delayed, they didn't pay that loan, they had a blemish on their credit report, it wrecked them buying another home. And I've also seen folks where they get excited to go buy furniture, they buy things for their new house, putting it on their credit card, changing the debt to income ratio. What is a debt to income ratio? Good question. Essentially, it's how much debt you have monthly payment wise and how much income you have. Your mortgage lender is going to tell you a little bit more about that. But if you have any questions at all, please give me a call.